When it comes to year-end tax planning, my message is simple: start early. The ATO is suspicious of transactions and adjustments done at year-end, and it's good housekeeping to integrate tax planning into transactions as they occur throughout the year. This provides time for reflection and action, so don't leave it to the last minute. Historically, year-end tax planning was focused on 30 June year-end with the aim of deferring income into a later year and deferring the tax connected with that income, and also to bring forward any deductions to receive the benefit as soon as possible. But that is old school. Today, tax planning should be part of business as usual all year round. I've identified 4 fundamental topics that make up the basics of year-end tax planning. Number 1 is your business structure. Is it the best fit for you, or is there a better way? Different structures produce different tax outcomes. Your business may have changed significantly from when you first started. Is your structure still fit for its purpose? The second topic is management of trust distributions and loans. Thirdly, and traditionally, I'll talk about income and ask, is it assessable this year or maybe in a later year? And the fourth topic, and the final one, are you claiming all the deductions you can? If your transactions are irregular, profits and losses, you don't want to be assessed in one year and have a useless deduction in the next year. Okay, let's start with your business structure. Your business structure significantly influences your asset protection, your tax management, your profit sharing, access to losses, succession planning, and estate planning. Some tax losses can be lost in the structure. Other structures allow good access to the losses. The business structure will also influence your annual compliance costs. Consider this. The most valuable business tax concession is the small business CGT concessions. These concessions allow eligible taxpayers to significantly reduce the tax payable on the sale of their business assets, often reducing the tax to zero. Now, let's overlay that issue with the issue of structure. A 19% shareholder of a company will not access the small business CGT concessions on the sale of their shares, but a 19% partner will access the concessions on the sale of the interest in the partnership. Here's another example of structural tax planning. If your net worth is under $6 million, then you can access the small business CGT concessions. But if your net worth exceeds $6 million by just $1, you have no access to the concessions. You just fell off the cliff. It's important to know if you're about to lose access to the concessions and consider what that means for you and what can be done before it's too late. There are things to do, and this is real tax planning. Different circumstances need different structures and produce different tax outcomes. So if you want a review of your ownership structure, make an appointment to see me or another CFMC director. Many clients enjoy the benefits of flexible income distributions with trusts. However, the world of trusts has changed. The ATO's intense review of the taxation of trusts over the last few years has increased the importance of managing your trust affairs properly. The ATO now accepts that many Australians legitimately run their businesses and hold their investments in trusts. But along with acceptance comes high compliance expectations from the ATO, and the penalty for non-compliance is also high. Your documentation must be in place in a timely manner. You cannot document activities and decisions some months after year-end when the final accounts are being prepared. Agreements must be documented, and loan repayments and interest payments must all be done on time. So if your structure involves trusts, then proper, regular management of loans and trust distributions is now essential. Let's turn to the consideration of your income. The key question to ask is whether you have income that is properly assessed in a future year. For example, you may have received money under a contract for services that you'll perform in the next year. If you don't perform those services, you'll have to repay the money. In this case, the income is not assessable until the year in which the services are performed. Timing is everything. There's many tax rules that determine when income is assessed, and a careful analysis of your affairs to consider what income can be deferred is generally worthwhile. Finally, let's look at planning opportunities around deductions. Some expenses must be made before 30 June in order to get a tax deduction, but some don't have that requirement. Make sure any bad debts are recognised by 30 June and make sure all employee superannuation payments are physically paid by then too. Then consider if there's any expenditure that you're committed to but not yet paid, a tax deduction will be available in those circumstances, so don't miss out. Do you have any opportunities to realise losses? Think about foreign exchange and losses and how they interact. Tax rules provide a variety of ways to value trading stock. Review your tax position to find the best valuation method. And while you're looking at stock, don't forget to identify any obsolete stock. Look at your plant and equipment. If it's obsolete, scrap it and claim the deduction. There are different ways to claim a deduction for depreciation. Work out the best rate and the best method for you. Remember that some prepaid expenditure is tax deductible for investors and small businesses. And my last word on deductions, superannuation. Make sure you structure contributions to maximise the benefit. So there we are, a quick tour around the tax planning fundamentals. I hope this summary will help you in your tax planning.
We've drawn up a sticky note containing the essential details, which you can access from our website at www.cfmc.com.au. Just click on the publications link on our homepage or call us for an obligation-free consultation. We'd be happy to help you with any questions you might have.